Welcome to Talk Tickers. We're your guide for cutting through all that earnings season noise and really getting to the critical insights you need to stay ahead.
That's the goal.
Today, we're doing a deep dive into Forrester's Q2 2025 earnings call. We want to give you the essential nuggets, the strategic implications, so you really understand what's driving this company.
Yeah, it's a pretty fascinating picture for Forrester right now. You've got a company navigating, persistent economic headwinds, but also doing this significant internal transformation.
Especially around AI, right?
Exactly, especially leaning into technologies like AI. So we'll unpack the numbers, look at the strategies management's putting in place, and try to figure out what it all means for where Forrester's headed.
Okay, let's jump right in then with a snapshot. Forrester's Q2 2025 performance. It was a quarter where, despite what they called, lingering macro uncertainty, they actually delivered above consensus expectations, on the bottom line anyway.
Right, which is a signal of strong execution, really. They reported adjusted EPS, that's earnings per share, adjusted for certain items of 51 cents.
I see.
Which is a slight beat against the $1.50 consensus analysts had. And revenue also came in a bit higher, $111.7 million versus about $110 million expected.
So small beats, but beats nonetheless.
Yeah, exactly. It shows, I think, impressive operational discipline in what's still, a pretty challenging environment for many businesses.
But okay, here's where it gets really interesting for me. While they beat those expectations, the top line stuff, overall revenue, new business, that actually saw some year-over-year declines.
That's right.
Total revenue was down 8% compared to Q2 last year. And contract value, or CV, the value of their active contracts, that decreased by 7% year-over-year. So how do those two things fit together? Beating profit expectations while revenue is shrinking.
Well, that's really the core of the Q2 story, isn't it? Management clearly put an intense focus on the things they could control.
Their costs, mainly.
Exactly. Their cost structure, and also making sure their strategic initiatives were running efficiently. And that sharp focus, that discipline, it allowed them to beat the street's profit expectations, even with revenue falling. It sent this cautiously constructive signal to the market. And we saw the market reacted pretty positively right after the call.
So the market liked the discipline, even with lower growth for now?
For now, yes.
Yeah.
It seems the market is rewarding that efficiency and a clear path to profitability over just pure top-line growth at this point.
Okay, so if that's the snapshot, let's get into the nitty-gritty of Q2, understand where these numbers actually came from. How did the different segments inside Forrester perform?
Well, let's break it down. Their biggest segment, research revenue, they came in at $77.9 million.
Okay.
Now, that was down 7% year over year. Or, if you exclude the Feedback Now divestiture, it was down about 5%. Still down, but,
Right.
And then you have consulting revenue. That was $23.4 million, a 5% decrease year over year. What's kind of interesting there is that the rate of decline in consulting seems to be slowing down, decelerating.
So maybe stabilizing a bit?
Could be. Could indicate a bottoming out, maybe.
Yeah.
But the events business, that faced the biggest challenge. It brought in just $10.2 million.
Wow. Okay.
Yeah. That's a pretty substantial 23% decrease compared to last year. So it's a stark reminder, really. Some segments might be stabilizing, but others are still very much feeling the pressure.
23% is definitely significant for events. But looking at their overall financial health, their balance sheet, capital allocation, how are they positioned there? Seems fairly strong considering the revenue situation.
Oh, absolutely. That's one of Forrester's real strengths right now, their balance sheet. The company has a really robust cash position, about $135 million in cash.
And debt.
Very little, only $35 million in debt. So that gives them a huge amount of financial flexibility, which is critical when the economy is uncertain. And for the first half of the year, their cash flow from operations was $23.1 million. It shows they're still generating cash from the core business.
And they mentioned buybacks, too.
Yes. Looking ahead, management plans to restart their stock repurchase program in the second half of 2025. They've got about $80 million left in authorization.
Which signals confidence in their own stock price, usually.
Exactly. It's a clear signal to investors that they likely see their stock as undervalued and they're committed to returning capital. It helps put a bit of a floor under the share price, too.
So, okay, we talked about revenue declines, especially in events, but they still managed to beat profit expectations. That brings us back to that operational discipline you mentioned. What did that actually look like?
Well, it was mainly driven by some pretty aggressive cost controls. Operating expenses overall decreased by a notable 6% year over year.
And how did they achieve that?
The biggest lever, really, was headcount. A significant 12% year-over-year reduction in their workforce.
12%. That's quite a cut.
It is. And that kind of reduction, it's often painful internally, obviously. But it allowed them to improve their margins and beat those profit expectations despite the top-line pressure.
The question then becomes, can they sustain that while still investing in growth, like AI?
That's the critical question looking forward, absolutely. Have they cut fat or have they cut muscle? Can they keep this cost efficiency going and invest sufficiently in those key growth areas?
Right.
Okay, so shifting gears a bit from the pure financials, let's talk about the strategic initiatives, the operational progress they highlighted. What did we learn about, say, their sales transformation efforts? Because that's key for future revenue.
Yeah, and this part is actually pretty fascinating. There seems to be some real underlying strength building in their sales engine. The total sales pipeline, for instance, increased an impressive 15% just quarter over quarter.
15%, that's not insignificant.
Not at all. It indicates pretty robust lead generation, a growing interest in what they offer. And on top of that, there's this really strong strategic push for multi-year contracts. Making the revenue stickier.
Precisely. About 72% of their contract value is now under multi-year agreements. That's up about 8 percentage points from last year. And interestingly, 22% of those are now 3-year deals.
3 years, okay.
Yeah, showing even deeper commitment from some clients. And why does this matter? Well, multi-year contracts mean more predictable, recurring revenue, higher client stickiness, exactly what investors love to see.
Okay, so a bigger pipeline, stickier contracts, those are good signals. But how are they making sure those leads actually, convert into closed deals? A big pipeline isn't much good if things don't close.
Right, and that's exactly where management's focus is right now. They're acutely focused, they said, on improving conversion rates from that growing pipeline.
How? What are they doing?
They mentioned initiatives like getting managers involved earlier in the sales process, trying to identify the really serious buyers sooner, and, avoid wasting time on deals that probably won't close anyway.
Kind of like a quality control earlier on.
Sort of, yeah. We also heard the average time to hire new sales reps improved by 21% compared to Q1. That's important if you need to scale up. And their sales force apparently has good tenure. About 75% have over 25 months of experience.
Experienced team.
Yeah, so even with some turnover from performance management, you've got this blend of experience and better hiring efficiency. It suggests a more mature, potentially more effective sales operation taking shape.
Okay, so a lot of focus on the sales engine, but a huge point of discussion and a really key strategic pillar for them is their AI tool, Izola. How is Forrester positioning itself there, and what's the engagement actually look like? Is it just hype?
Well, they're definitely positioning themselves strategically as a leading AI research company with Izola at the center. And the engagement numbers, they seem to back that up, at least directionally.
What kind of numbers?
We saw significant growth, a 22% quarter-over-quarter increase in users. And even more striking, a 44% quarter-over-quarter jump in the number of prompts, questions asked of Izola.
44% increase in usage, quarter over quarter. Okay.
Yeah. And here's maybe the hidden implication or the interesting detail. Recent enhancements mean Izola can now pull answers from graphics, figures, charts within the research, and users can chat directly with specific reports.
So digging deeper into the content.
Exactly. And apparently over half of all Izola prompts now originate from within a report. That suggests it's not just casual curiosity. Clients seem to be integrating it deeply into their workflow for serious, in-depth analysis.
Making it more indispensable, less of a novelty.
That's the idea. That signals potentially powerful stickiness and value. Right now, they're monetizing it by embedding it within their core Forrester Decision subscriptions. So it drives engagement by being part of the main package.
And clients are biting?
It seems so. They mentioned clients identifying generative AI as a top 3 initiative across all 14 of their Forrester Decision services. That's a pretty strong testament to its relevance right now.
Okay, interesting. And beyond Izola, they also rolled out some new foundational research frameworks. These sounded like pretty core tools for their clients.
They did, yeah. And these do seem foundational. 2 impactful new research constructs, really addressing major market shifts. First, at their B2B summit, they introduced something called buying networks.
Buying networks?
Yeah, it's a framework to help their B2B clients navigate these incredibly complex, multi-stakeholder buying decisions that are happening now, especially with Gen Z buyers coming in, AI influencing the research process. It's messy out there.
So a roadmap for complex B2B sales.
Basically, yeah. And second, in the B2C space, they debuted the Total Experience Score. This combines brand perception and customer experience indices into one unified metric.
Okay, a holistic view.
Right. And apparently, it's already resonating. They said they've held over 100 guidance sessions with clients on it already. It gives clients this broader view of how customers see them, helping them find ways to improve growth and retention across the whole journey. These frameworks really help solidify Forrester's thought leadership and provide tangible value.
Okay. Now, we mentioned earlier that the events business is still a significant challenge. What are they actually doing to try and turn that around? Is there any light at the end of the tunnel there?
Yeah, this is definitely an important question for their future growth mix. Events is facing headwinds, no doubt, mostly from a big drop in sponsorship revenues, even though attendance itself has actually been going up.
So people are coming, but sponsors aren't paying as much.
That seems to be the issue. So, to tackle this, they brought in a new head of events, Tavar James. He's focused on, well, refreshing the offerings, developing more competitive, maybe more innovative sponsorship packages, thinking beyond just the standard booth, and also upscaling the sales team to sell the value better.
Makes sense.
And a major strategic move they announced is relocating a key CX event. It's moving from London to Amsterdam for 2026.
Oh, interesting. Why the move?
Partly driven, they indicated, by Brexit-related issues, things complicating logistics and sponsorship in the UK, and apparently the move to Amsterdam is already drumming up some new sponsorship interest.
So maybe a positive catalyst there.
Potentially. And like I said, attendance at their CX summits in North America and Europe was actually up 11% and 21% respectively. Satisfaction scores are apparently at an all-time high. So the content, the experience seems strong. The challenge is purely monetizing those audiences via sponsorships right now.
Got it. Okay, so we've covered the financials, the strategic plays. What does this all mean for the bigger picture? The economic backdrop, their forward guidance for the rest of the year? Are things easing up at all?
Well, they're still saying they confront ongoing economic instability. It's affecting both their enterprise clients and their vendor clients. It's not an easy environment to operate in, clearly.
But any bright spots?
They did mention seeing pockets of building momentum. Particularly noticeable, they said, in the government sector.
Oh, government contracts.
Yeah, driven by some competitive wins and strong interest in generative AI applications, both from U.S. state and local governments and also European federal agencies. So it suggests that even when the overall macro picture is tough, there are specific areas where their offerings, especially around AI, are really cutting through.
That could be a good sign for broader adoption later, maybe?
It could be a blueprint, yeah, as they refine that go-to-market strategy.
And how did all this translate into their actual guidance for the full fiscal year 2025? Did they change anything?
They actually reaffirmed their guidance for adjusted operating margin, kept that between 8–9%, and also their adjusted EPS forecast of $1.20 to $1.35.
So confident on profitability and cost control.
Seems so, yes. Demonstrates confidence in that cost structure. However, they did tighten the full-year revenue guidance range slightly downwards to $410 million now.
Okay, what's driving that lower revenue outlook?
It represents a 5–8% year-over-year decline now, and the adjustment was mainly driven by a weaker outlook for consulting, now expected to be a mid to high single-digit decline, and especially that events business.
Ah, the events impact again.
Yeah, events is now projected to have a pretty substantial 20% decline range in the second half. Research business outlook stayed about the same, a mid-single-digit decline.
But any positive note in the guidance?
Well, on a more positive note, they do anticipate contract value, that CV metric, to improve to just a low single-digit decline for the full year. So that suggests stabilization might be getting closer.
Okay. Let's talk investor context then. How did the market take all this?
Well, as we touched on, the immediate reaction to the Q2 results was quite positive, actually. The stock price jumped 12.3% the day after the earnings call.
Wow, 12%.
Yeah, on significantly higher trading volume, too. It really suggests investors rewarded those EPS and revenue beats, and especially the clear operational execution, even though the top-end revenue outlook was trimmed a bit.
Focusing on the here and now, the profitability.
It's exactly rewarding the disciplined management in the current climate.
Right. But if you zoom out a bit, it's a more, shall we say, nuanced picture, isn't it? While Forrester's stock did outperform the S&P 500 over the last month,
Just slightly. Yeah.
It has significantly underperformed over the past year, like massively. We're talking down roughly 45–50% compared to the S&P 500 being up 20%. That's a huge gap.
It absolutely is. And that long-term underperformance, well, it's been influenced by things like a prior goodwill impairment, basically having to write down the value of something they acquired, and also the ongoing restructuring efforts. It hasn't been an easy ride.
But maybe this Q2 call offers some green shoots.
It does provide potential catalysts for what we call re-rating or multiple expansion, meaning investors might start valuing each dollar of Forrester's earnings more highly, reflecting new confidence.
What are the key things investors should be watching for then?
Key watch items, I'd say, are continued improvement in those sales conversion rates, turning that bigger pipeline into actual deals. Sustained success in new use cases for Izola, showing it's really embedding itself. Any kind of tangible recovery in event sponsorship revenue, and of course, the impact of restarting the stock buyback program.
And that contract value stabilization.
Absolutely crucial. Sustained evidence that CV is stabilizing and potentially turning positive. That will be critical for any significant long-term re-rating of the stock.
Okay. All right. It is time now for our This Is Not Financial Advice segment. This is where we pitch an outrageous but maybe plausible trade idea, like a hedge fund analyst talking to their investment committee. Your turn.
Okay, here we go. Given Forrester's Q2 performance, here's the thesis. We recommend initiating a long position in Forrester, ticker FOGR. We're targeting, say, 25–30% upside over the next 12–18 months.
Bold. Okay.
The rationale. We believe the market is significantly underappreciating management's strategic pivots right now. I mean, think about it. They have fundamentally shifted towards multi-year contracts that's now 72% to CV, locking in future revenue.
Okay, then, yeah.
Simultaneously, client engagement with Izola, their generative AI tool, isn't just growing, it's accelerating and becoming deeply embedded. Remember, over half of prompts now originate within client reports. That's real usage.
Okay.
Now, yes, events remains a drag, we acknowledge that, but the significant 15% quarter-over-quarter sales pipeline growth, combined with these very visible, focused efforts to improve conversion rates, it suggests to us a sharper inflection point for CV stabilization coming in late H2 2025 and into 2026 than is currently priced into the stock.
So you think the turnaround is closer than the market believes?
We think the stabilization is closer, leading to a potential turnaround narrative. Plus, the planned restart of share buybacks, while maybe modest in absolute terms, provides a tangible floor and signals management's own confidence. So look, this trade isn't just a bet on a simple turnaround. It's a bet on a fundamental re-rating of the stock's multiple.
As they become more of an AI story.
Exactly. As Forrester solidifies this leading AI research company narrative, as they deliver more predictable, recurring revenue from those multi-year deals, and as they finally move past the shadow of prior restructuring and the current economic noise. We think the market is still looking too much in the rearview mirror here, not at the road ahead.
There you have it, the pitch. Remember, everyone, that is explicitly not financial advice.
Definitely not. Just a thought experiment.
Okay, so to bring this all together for you listening, Forrester's Q2, it really showcased a surprising resilience, didn't it? Beating expectations on the bottom line, even with those top-line declines still happening.
Yeah, they're making some very deliberate, very strategic plays with AI, pushing hard for those stickier multi-year deals and, working intensely to fix that events business.
It's clearly a company in transition, but one where you can see management actively deploying very specific strategies to try and navigate this uncertainty and hopefully drive future growth.
Yeah, we saw real evidence of that operational discipline paying off on the bottom line.
Yeah.
And you can see clear areas where momentum is starting to emerge, particularly around AI and that sales transformation piece.
Well, thank you for joining us for this deep dive into Forrester's Q2 2025 earnings call. Remember, all this information is for your knowledge, your insight. It is not financial advice. We always encourage you to do your own research, connect your own dots.
Absolutely. We hope this gave you the critical insights you needed to really understand Forrester's current situation and trajectory. Keep a close eye on those sales conversion rates and how Izola continues to evolve within client workflows. That's going to be key.
Definitely. Until next time, stay informed, keep digging into those numbers, and we'll catch you on the next Talk Tickers Deep Dive.